Hi, everyone. Today I'd like to cover digital credit, Bitcoin, and the rise of the preferred playbook. If you want to understand where Bitcoin Treasury finance is going, watch the preferreds. I think of these as the early building blocks of digital credit. Capital that behaves like credit, pays a stated yield, sits senior to common, has explicit terms, but is purpose built to finance corporate Bitcoin treasuries. Let's maybe start with the leader everybody knows, Strategy, the company formerly known as MicroStrategy. They just reported about $2.8 billion in Q3 2025 net income with year-to-date Bitcoin yield of roughly 26% as of late October. And they reiterated that the machine here is balance sheet Bitcoin plus capital markets engineering. But look past the headlines and the P&L and into the capital stack. Strategy has leaned heavily on preferred equity alongside common ATMs to fund additional Bitcoin. Earlier this year, market coverage showed their preferred series clearing at yields at 9.5% to 12% during bouts of volatility, precisely the kind of credit-like return that income investors notice, especially when risk-free rates are around 4%. So 2 takeaways on Strategy. Number 1, the preferreds have become a dial they can turn, raising non-voting yield-bearing capital without immediately stressing the common. Number 2, as the cycle matured in 2025, management doubled down on this toolkit while continuing to buy more Bitcoin. For example, a mid-year ad of 4,980 Bitcoin for $532 million via the ATM programs. This is the digital credit flywheel at work. High coupon preferreds that fund new Bitcoin, which expands asset coverage behind the stack. Now let's compare that with Metaplanet in Japan, arguably the most interesting non-US laboratory for the model. In 2025, Metaplanet showed 2 big moves. First, it used low-cost local funding, zero-interest ordinary bonds to accumulate additional Bitcoin back in the spring. Later analysis highlighted that their Bitcoin assets dwarfed their debt by a wide margin, implying substantial over-collateralization of liabilities by their Bitcoin stack. Second, they pivoted to preferreds. By October, Metaplanet had shareholder approval to issue preferred shares. So you can see how management is trying to manage valuation as well. In October, they brought a Bitcoin-backed stock buyback program up to $500 million over a year, aimed at addressing the discount of equity to asset value. So if Strategy is the US blueprint, Metaplanet is showing what's possible under a different regulatory regime. Rapid serial allotments, short tenor paper, and now preferreds, essentially an ATM-style conveyor for Bitcoin accumulation supported by credit-like instruments. Third example, Today with Strive, illustrates how quickly this playbook is being copied. Today, Strive announced its intent to sell 1.25 million shares of a variable rate Series A perpetual preferred SATA with an initial 12% dividend to fund additional Bitcoin purchases. That's pure digital credit, market clearing, perpetual structure, proceeds earmarked for a Bitcoin treasury. So if you put all these 3 together, you can see a pattern. Preferreds let these companies price capital where traditional unsecured debt might be expensive or unavailable. They're equity for legal purposes, but economically credit-like, a coupon, seniority to common, and in some cases, in some series, call, convert, or dividend deferral mechanics that change the risk-return profile. Strategy's 2025 series, trading at near double-digit yield, shows that there's investor interest and that there's an investor base for income with Bitcoin asset coverage. Right now, it's really important because the macro math has changed. In a 2% rate world, a 10 to 12% preferred looks spectacular. In a 4% rate world, it still looks compelling, but the bar for perceived risk and governance is higher. That's why disclosure, custody, and coverage ratios matter. Strategy's Q3, for instance, reminded markets the asset base is a large and this year profitable. Metaplanet emphasized the over-collateralization. Strive is leading with double-digit coupon and a clear use of proceeds. So let's think through what the risks are that investors are actually taking. You have dividend risk and deferral. Some preferreds allow dividends to be deferred or paid in kind, which can jack up the effective yield, but adds timing risk. Barron's flagged this dynamic when Strategy cut offering price and implied dividend math stepped up. You have market drawdown and asset coverage, and you also have execution risk. So why are we calling this digital credit? Why call this digital credit? Because these preferreds are they're the funding pipes into corporate Bitcoin treasuries. They're not tokenized loans or on-chain credit yet, but they're the first wide adoption market-priced credit layer wrapped around corporate Bitcoin. The coupon is the carrot. The Bitcoin on the balance sheet is the coverage story. So what should we be looking for next? Series proliferation and term diversity. Strategy has already shown how multiple preferred series, each with different seniority or features, can clear different yields. So maybe we can expect more tickers, more tiers in the industry. Cross-border structures. You look at Metaplanet's regulatory context, it allows faster issuance cycles and perpetual preferreds. Watch how that influences companies in the US or pushes more issuers to explore non-US venues for digital credit issuance. Cost of capital versus Bitcoin beta. If risk-free rates ease again, double-digit preferreds look even more attractive versus 2 to 3% cash. If rates stay 4% plus, which we don't think they are, you can expect investors to demand cleaner governance, clear asset coverage, and perhaps step up or reset features in new series. Also, use of proceeds discipline. Strive is explicit. Raise preferreds, buy Bitcoin. If issuers drift into general corporate uses without reinforcing Bitcoin coverage, spreads will likely widen. So the bottom line is digital credit for Bitcoin treasuries is not a thought experiment anymore. It's here with Strategy scaling preferreds beside their ATM, Metaplanet layering perpetual preferreds and buybacks around a massive Bitcoin stack, and now Strive entering with a 12% perpetual preferred to fund new Bitcoin purchases. The instruments are old world in legal form, but the economic engine, Bitcoin as the core reserve and asset coverage, is obviously distinctly new. If you believe the Bitcoin treasury company is a durable category, then the preferred market is the tell. It shows you the current cost of capital, the real investor risk appetite, and the discipline, or lack of it, in treasury engineering. Watch the coupons, watch the coverage, and watch who can keep funding at scale when the next volatility spike hits. If you want to go deeper, check out Strategy's Q3 2025 press release and Bitcoin yield metrics, Barron's coverage of Strategy's preferred yields, Investopedia on Strategy's $530 million Bitcoin purchase via ATMs, and Bloomberg, Yahoo Finance, and CoinDesk on Metaplanet's preferreds, bonds, and buyback. And of course, today's Strive announcement of the SATA preferred, perpetual preferred at 12%.